Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Monday, June 24th, 6:11 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Back in the saddle after a nice week-long vacation. Great job by Ted and Connor filling in, doing the videos. I don't think we missed a beat. I was very impressed by the job the fellas did while I was out, and back now. And Tuesdays you'll have Tedder Tuesdays and Connor Thursdays. I'll be doing Monday, Wednesday, Friday going forward. So let's get into it. State of the market still in an uptrend. Check the trend gauge over here. Still four green arrows. We've got some things getting worse, some things getting better. Getting worse, our leadership is leadership, more specifically, any AI tech related leadership, especially semiconductors, as it's been 3 hard days down for big tech and in particular semiconductors now. 3 day pullbacks, frequently that's where a bottom is found, especially if that coincides with a main support level. We'll talk about that as we get into the videos. Improvement, though, and the different time frames that we track. We've seen Dow get back above the 21 and 50-day moving averages last week, as that started on Thursday with the rotation into large value and mid and small. Today we saw further rotation into mid and small as mid caps regain their 21 and 50-day moving average. Small caps, I'm speaking specifically about the Russell 2000 index, uh, early on got back above both of those levels, but faded by the close. So we still got the yellow arrows there. But the market never gets into serious trouble unless the S&P and the other averages start to break below the 200-day moving average. That's where all bear markets occur. As long as we're above the 200-day moving average, we keep an allocation to the S&P 500 and or other indexes that are acting well. And in uptrends, we focus on leading stocks in leading sectors to improve the returns versus the index. That's basically how we do things here at Revere. So what happened today? As I mentioned, third day down for tech, specifically semiconductors, and outperformance by large cap value. The Dow is basically a large cap value index, and we saw that last week with rotation into it after a massive period of massive, maybe a bit hyperbolic, but after a pretty long period of underperformance on the Dow as growth stocks led the way. But that top happened on Thursday, and now day three down. We'll check the support levels when we get into the charts. And mid and small caps outperforming today as well. Here are the final numbers. 21 over 21. We'll talk about what dropped and what got added. Slight positive on the day by 0.2%, 11 up, 2 neutral, 8 down. The big eight, no chance with Nvidia being down 6.7%. The big eight down an average of 1.4%. The RG8 just barely down 0.1%. S&P 500 opened down about 0.1%, rallied strongly up until about 10:15 and then faded, ended up down 0.33%. But revenge of the equal weight S&P 500 continues. The RSP up 0.5%, as we're seeing that rotation from the few big names going into other sectors and other names within the S&P 500. NASDAQ 100 opened down 0.33%. Things got worse from there, ended up down 1.14%, equal weighted down 0.4. The Dow, oh, the forlorn Dow, looking so strong now, up 0.67%. Same thing with mid caps, up 0.6%. Small cap, Russell 2000, up by 0.4. Global diversified 60/40 stock and bond, just barely positive. Our in-house flagship portfolio, GROTECTION, down 0.5%. Third straight day of underperformance. And that's primarily because CrowdStrike and Nvidia, our two biggest holdings, are pulling back. We've hedged quite a bit in Nvidia, but not avoided all of the pullback by any means. We'll talk about how we hedged it as we get into this. So let's get into it, and we'll start off with the chart of the S&P 500. The 60-minute shows the story here. Let's draw a couple of lines. Here was our breakout level. That's not a very good line now, is it? Let's go to the 60-minute chart again. And since I'm rusty, we'll try this again. So we broke out above this 53.75 level on the 12th, went sideways for 3 days after that, broke above 54.50. Late day on the 17th, followed through on the 18th, made a higher high last Thursday, and then started to fade. This was the gap up. Nvidia popped 140 bucks, and we just faded since then with big tech. This was kind of like seemed to be a little bit of a blow off now in some of these AI data center names. So we pulled back there, held those lows, Thursday's lows on Friday, closed slightly below there, or undercut, but closed slightly above that. No, we did close below it. 54.49 is less than 54.52, no matter how you do the math. And so closing back below this 54.50 level, which we kept an eye on. So this means that this breakout has been neutralized and this breakout has not been. So the range that we're looking for now is this 53.75 to 54.50 level, this 75-point range. We just pull back and regain and attempt make an attempt at higher highs. After today's third day down in big tech, only the market can decide that. We just prepare for different scenarios. Let's go back a little bit further. You got this 53.35 level. So really there was a 5-day consolidation there, a gap up, a 4-day consolidation there, another move higher. And we've given back most of that on the or all of it in the S&P 500, the last one. Now this looks worse. The NASDAQ 100, that breakout clearly given up, and we're testing the second breakout, this being the first breakout above 460. So we're into the second level. And again, this is what happens when things just get too extended to the upside. You had this gap up last Thursday, and that was just a little bit too much. And we've been selling off consistently ever since then. So here's a downtrend line we'll be looking to get back above. And the support level will be this gap down on the NASDAQ 100. And that level to fill that gap is about 467, 468-ish. Let's go back to the daily chart to see if that tells us anything. Where's 467, 468? Well, that's right on the 21-day moving average right now. So a further level of support should we get back down there in the next couple of days. But the NASDAQ 100 has broken below the 8-day exponential moving average, our ultra short-term indicator. Let's go back to the daily on the S&P, and you can see that it is holding the 8-day moving average. And this is purely, again, I reiterate it, why we keep a big big portion of the portfolio, a ballast, a cornerstone, there's a couple of names you can call it, but it's a foundation. And all the rotation takes place within the S&P 500, and that's what we've been saying. The NASDAQ 100 went up faster, but pulled back harder than the S&P 500. And frankly, we're just not good enough to catch every one of these little rotations out of value and from various sectors. So we let our leverage exposure, not all of it's leverage, some of it's leverage, some of it is SPLG. We let that handle all the sector rotation. As long as we're above the 21-day moving average, we keep that exposure to at least 50% beta, 0.5 beta of the portfolio. We got as high as 0.7. We dropped it down last week with some of these when we got extended 3 ATR above the 21. We do that frequently. And we'll see if we get the pullback to the 21. We will at some point. If it coincides with this gap, that'll be 2 levels of support, and we'll look for a bounce there. But all in all, and I think the guys hit it on the head last week when they said we are seeing rotation, particularly on Thursday's video. And what we've been seeing is sector rotation, and that's what we've seen for the last 3 days, not only within sectors, but also within market caps. So that's enough of the S&P and the NASDAQ 100. Let's go to the Dow, which lagged for so long, but now has been up 5 straight days, very clearly reclaiming the 50 and 21-day moving average, showing big relative strength since the middle of last week. So the revenge of the Dow this week and late last week. Let's go to the S&P 400 mid cap, and you can see this is an index that has now regained the 21 and 50-day moving average. We want to see the slope of these lines, which is still slightly lower, hook back up and provide support on any pullback in mid caps. And you can kind of see a downtrend line here that we're trying to break through. Ran into the top of it this morning and pulled back, but still held above the moving averages. And you can see the relative strength there as well. Now let's go to the Russell 2000 small caps. Here's a downtrend line with a false breakthrough 2 weeks ago. We ran into it again today. Got above the 50 and above the 21 early in the day, but faded there. So obviously we want to break that downtrend line, get back above there. You can see the relative strength line today on that and a bit last week. We're seeing the RSP equal weighted S&P. You're seeing the relative strength on that after lagging for a long period of time because big cap tech was just taken off. So regaining the 21, making a higher high today was the RSP. Let's look at QQEW. This is the equal weighted NASDAQ 100. Nowhere near as harsh a pullback as the NASDAQ 100 pullback. But then again, it didn't break out the way that did either, because you can see by the relative strength line here, that was lagging versus the big cap tech names. So that's our review of the big five indexes. Next up, let's flip to the VIX. And the volatility of the Dow or the S&P 500 continues to contract. It's under 0.8% right now. Although the VIX has popped up from 12 near 14, and that coincides with the pullback we've seen in the S&P, so not really a surprise there. Let's look at the dollar. Dollar continues to consolidate for about the last week in sort of a breakout range. That's a headwind normally for stocks. We don't want to see this going higher. We prefer a weaker dollar. Stocks generally prefer a weaker dollar. Onto gold and gold stocks, GLD, tight range today, up 0.4%. Attempted breakout last Thursday, failed on Friday, inside day today. GDX, we're looking at this on some strength as for a possible entry. And the reason why is because we saw one stock in the sector clearly stand out. That's Newmont. So you can see serious relative strength on that relative to the GDX and the other big names. And this is an institutional liquid favorite, trading 10 million shares a day. So that's GDX. Kind of an inside day today, but ran into it's right around the 50 and the 21-day moving averages. Silver, high host silver, big gap up last week, gave that up, most of that on Friday, tight range today. I don't really just don't have a good feel for playing silver. There is a downtrend line here you could watch. There's also the pivot that it's been going above and below, no real support there. You could say the most obvious support has been the 50-day moving average on this pullback since we got back above it in March. So a break of that would be an intermediate change in character. How about Bitcoin? Man, relative to the moving averages, forget it. Relative to this big base that it's forming, it's at the bottom of it. So this is when all of the ETFs came public. That was euphoria. We sold off, very clean breakout at this 30 level, strong run higher, and we went up to 42 and have now pulled back to 34. 23% base is kind of normal for a growth stock or even a non-growth stock compared to the S&P. So as far as the base goes, things are okay. There's just a lot of disappointment in, maybe it was just too obvious when we got up near the top of this range. Everybody thinking we're going to break, and we did break, but we broke lower, not higher. And we don't own this anymore at the present. We sold all out of it last week with the failure against the 50-day moving average. So that's Bitcoin. On to bonds. This is going to be a long video. BND here, broad bond index tight range for about a week and a half, sitting right on the 8-day moving average. Long bond TLT, kind of a tight range as well, up 0.40%. Prices up means yields down. Let's take a look at the 30-year. The 30-year is the TYX, and yields near the bottom of this range, consolidating for about a week. The NX 10-year yield consolidating as well near the bottom of the recent range. So that's our inter-asset correlation. And let's go to the tail of the tape. You can pause this. I'll hit the highlights. Friday morning, we've got PCE inflation data. That'll be important. Day count. The 1-day break, and this is the S&P day count, up one, and 4-day consolidation. That's the latest breakout, and we're right at the bottom of that breakout level. 15 days above the 8 EMA, that's a lot historically. 16 days above the 21. Our expectations are positive, but that short-term extension on the S&P and the NASDAQ 100 has been worked off pretty quickly, 3 days, and pretty harshly if you're in AI data center stocks and you didn't obey stops. So sectors today, 9 out of 11 up. Oils, gold and gold stocks, banks, builders with the pullback in interest rates, though it was mild. Dollar down, Bitcoin, XLKNY, two of the three tech sectors, SOX and IGV, obviously semiconductors and software. So the portfolio, 2 buys today, NRGU and Meta. We'll look at that when we go through the new 21 over 21. And we've been hedging Nvidia. Net, our exposure increased from 1.04 to 1.11. Bottom line on the day 3 of tech weakness, especially semiconductors. Value, and it's really large value, slash Dow. The Dow is a large value index. Mid and small caps lead again. So the rotation is very clearly happening. It's happening with a sledgehammer to the leading names for the most part. Nvidia is down 15% off of its highs. And speaking of Nvidia, we'll look at that first, and we'll talk about how we were hedging. So the plan was when we broke above here, and the plan really had been in place since the split day, which was Monday the 10th. So let's get Monday the 10th here. Monday the 10th right here, we tested the 8-day moving average 2 days in a row and then broke higher. Everyone and their brother was saying we were going to gap up and fade. There was about a 30-minute fade, and then we took off to the upside, but a little too far, too fast. And ironically, we're now at 118, right at that level where we closed, below that level where we closed, which was basically 121 pre-split. So that run, escalator up, elevator down. So the plan was to hedge on a break of the 8-day moving average. We got a small hedge on the reversal last week. The guys talked about it on the video, and then added to it on Friday. Now, this morning, so when you have a hedge, and the hedge is, against the 8-day moving average, basically, and then you look at where's your next level down, and the next level down is the 21-day moving average, and that's a possible area to look at for support, and also to get out of the hedge if you're on it, if that support holds. So let's take a look at the SOX now. SOX also, along with Nvidia, was pulling back right to the 21. SMH is another semiconductor index, pulled back right to the 21. So let's go back to Nvidia. So the thought was hedge with a break of the 8, target 21, closing that out, and we did close that out today. The first part of the hedge today. Now, think of this as 3 different waves, and really it's about 4 different waves, the way we've done it. So about 119.50 was the 21-day moving average. So when we Friday put the first part of the hedge on, break of the 8, a little bit more, especially because we got back above the 8-day moving average and failed. That was a bit of a red flag. When we broke lower this morning, we put these were using NVDQ. This morning with this gap down, we put on NVD just to separate the trades. When we came down to the 21, we battled right around this 119.50 area for most of the day today. 119.50 is about right here. So you can see we came down the 21, tried to rally off of it, came down, broke below it, rallied off of it, and then late in the day gave that level up. So when we gave, so the first NVDQ, we sold that, took the profit, 23%, when we bounced at the 21-day moving average. 23% is great, but it wasn't on that big of a position. We had a quarter to a third of it hedged. And then NVD, we bought that today 3 different times. First time was when we broke below yesterday's low, targeting what were we going to do when we came into the 21. NVDQ, we sold that on the bounce on the 21. And then when we got back above the 21, but really weren't holding it with any confidence, we were kind of playing ping pong around it. When we failed at that level into the close, we added more to that hedge. So now we've got half of Nvidia hedged with NVD. Your risk on a big stock like this when it corrects is always to the 50-day moving average. That's a long way down, 16.3% from where we closed today, and we're down another percent after hours. So let's look at other support levels here. There was a break above this 116.50 level is where we broke out here on Nvidia on the 4th. This was pre-split. So let's go to a 15-minute chart here. No, we need to look at it on a 30-minute chart. And this was the breakout here, the breakout and back test on the 5th. All right, broke out, back tested it, a lot of volatility here. The split was on the 10th. This is where that early pullback was. We tested that level and held it. And then we went off to the races, and then what now is looking like an exhaustion gap higher and a hard 3-day sell-off. So we closed right at this level at 118.11, and we've got a little bit of a little more to fill the gap in this case, because that was around 116.50. And we've tested that level after hours and are bouncing around that level. So really 115 to 116.50, if you look back to this level, is the next level down for support. If we don't find support there, we'll go to a full hedge down to the 50-day moving average because we frankly just don't want to give back. And at some point we'll start, we hadn't done any individual selling except for some clients that came in and had very large positions. We reduced that lower in non-taxable accounts. But we're really factoring in, we had up to 400% gains for some clients from some trading that we did all the way back from the original breakout. Then there are some 90% gains, and then more recently, 40, 30, and 20% gains. So for non-taxable accounts, we'll just start taking that off and booking the hedge, and it kind of evens out, and there are no tax consequences. So it's really not a big deal. But for taxable accounts, we want to protect the profits down to the 50-day moving average, which is a very well-known level of support. So that's how we've been hedging. We certainly didn't avoid all of the losses here. We avoided about a third to a half of them with the various hedges, but we need to put up a stand here. One close below the 21 is not a big deal. Multiple closes below, and if it looks like we're breaking this level and that 115 to 116 level, then we've got the 50-day moving average in our sights, and this can be a very strong and quick drop down to the 50-day moving average. We've seen it before. There's also the fact that volume has really picked up over the last 3 days, while volume was puny, relatively speaking, while we started moving up. So that's those small volume gains very easily got sold into. And now we're at much higher levels of volume for this support. So if it holds, it holds. Their technical analysis isn't perfect. It gives you levels to play against and odds to consider. And then it's up to you to make the ultimate decision. So let's now move on to the 21 over 21. There are a couple that got kicked out last week. We'll talk about them and why. Start off with Abercrombie and Fitch because of weakness and a break below today. This should have held the 21. We've been seeing other retailers being sold, and the relative strength rolled over, and it was really relative strength call, and then coincided with the sell-off today. Coin broke badly. That was a no-brainer. That's gone, as well as ONLN, which is another apparel, although it's shoes and not clothes, but a hard break there as well. NXT broke on Friday, further below today. That's out. And PSTG, we took our profits in this. This is a data center name. Weakness, heavy volume selling, undercut and reclaimed today, but broke below today and taken off. So those are the 5 that were taken off. And I'll show you what was added when we get to the bottom of this list. But let's start off with First Solar. It's hanging right around there. It's kind of a lone wolf. NXT broke to 21. Enphase had some hope and broke down mercilessly, but this has been holding pretty well. We're going to give it a shot as a proxy for the overall sector, although TAN itself, the ETF, looks terrible. There's Nvidia sitting basically right on the 21, a bit below it. We're still holding it. We're hedging it as I just painfully described. I shouldn't say painfully, I should say in painstaking detail. Micron bounced at the 21-day moving average. Kava bounced at the 21-day moving average. TMDX bounced at the 21-day moving average. ELF broke above this 200 level, but is having a hard time holding it. Spotify hanging right onto the 21-day moving average. Coherent hasn't touched it since it's the big move up on the new CEO. CrowdStrike holding in there. Minor relative weakness over the last week, still our largest position, but not making any progress, and we will start taking profits on this. SARK, this is inverse ARK-K, holding above the 21-day moving average. Pinterest pulled back over the last 3 days, but not on heavy volume. So it is showing some relative strength as far as leaders are concerned. Apple, after hitting 220, had a strong open up today, but gave back most of it by the close. A bit disappointing in breaking the 8-day moving average. Palantir bounced at the 21 today. GEV bounced at the 21 on Friday and had an update today. Bros bounced at the 21 on Friday. SRPT, we bought this on Friday with the big gap up. Good action on the inside day on additional heavy volume today. So SRPT is one that got added to the 21 over 21. Uber also. This is holding up pretty well. Volume contracted. Friday's volume, anytime there's OPEX, you have to take the volume with a grain of salt. But this is looking like it wants to participate back above the 21, back above the 50. Some volume came in today when it tried to make a run, but was held back by the overall market. But Uber back on the 21-21 list, as well as Meta, which we bought today on that move above 500 that it couldn't hold. NRGU, big break of the 21-day moving average downtrend line. You got to buy energy stocks when the charts don't look the best, but they look like they're making a turn. It gives you a good risk reward, and we bought this today also, NRGU, and it should hold the lows from not only today, but 2 days ago as well. I like the 3-day up, 1-day consolidation, and then break above the 21-day moving average. Also got an alert on LNG on Friday. That had a negative reversal. That one trades a little bit different to the general big oil names. And anyway, NRGU, we also added Lilly, just continues to be a beast, and good to get another non-tech name in there. HIMS, medical stocks have been acting well. This had a nice bounce off the 21-day moving average, although it did run into, and you see this a lot, when you obey the 8 for a long time, break it, pull back to the 21, and bounce up into the 8, which rolled over. That's frequently a failure point, and that's what HIMS did today. So that's something that we'll keep an eye on. And then it's just a matter of the declining 8 versus the rising 21. one of them is going to win. And that's it. That's the 21st stock in the 21 over 21. This has been an excruciatingly long video, but a lot of catching up to do after being out last week, and a great job by Ted and Connor for keeping things going. And you'll have headers on Tuesday and Connor on Thursday going forward. And with that, I'm going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Our flagship portfolio is named GROTECTION because it is designed with a dual mandate: grow assets during uptrends, protect them during sideways markets or downtrends. Pull back a little bit in the sideways market, then let the market tell us whether we're going to sell more. We're keeping our beta at a minimum of a 1 as long as we're above the 21-day moving average. That's just one of our rules. But we really need to hold this level should we get back to there on the 21. This big move up, you're very aware how it was bolstered by Nvidia and the other big tech names, and those are pulling back 3 days down now. Very often 3 days down puts in a bottom, and you at least get a bounce, and then you judge the quality of the bounce. And with that, I'm going to wrap it for Monday, June 24th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening, and have a great day.